Hello, everyone, and welcome to episode 4 of The Pragmatic Investor. Today, I had the pleasure of speaking with Ryan Wilday. He is the founder of Crypto Waves on Seeking Alpha and an expert on Elliott Wave Theory. Now, I've actually been following Ryan's work for quite some time, as I also often use Elliott Wave Theory, and it was great to get the chance today to talk about the intricacies of this theory and what Ryan's thoughts are on crypto, stocks, and the economy in general. As always, I hope you enjoyed this conversation as much as I did. All right, so I'm joined today by Ryan Wilday and the founder of Crypto Waves. Obviously, the name quite self-explanatory there. So the first two questions might be quite obvious. So let's start with the crypto part of it. When did you first hear about crypto, or more likely Bitcoin? What is it about it that made you say, okay, this is something that I'm interested in?
Yeah, I mean, I think I have to go back before crypto because it gave me that gives the kind of context to why I would be interested in such a thing. I have a degree in industrial design, so I was an industrial designer I graduated from with my design degree in 1999. And I've been through consulting, and I've had some lead positions in various companies. And but it was interesting because I came out of school in 1999, and that's when we had the technology stock rage in the United States. A lot of people were day trading in my design office the first one that I worked at. And so from there, I started a deep interest in trading, and from whether it be from a fundamental perspective or technical analysis perspective, doesn't matter. I basically failed in those first couple years, but I kept going, and I kept the learning process going. And fast forward to 2012, I was working for Samsung Design America, which was one of the design offices in the United States in downtown San Francisco. And one of the guys that worked for us was a programmer from Sweden. And he just simply asked me a simple question: have you ever looked at Bitcoin? We're talking about trading and investing. You ever looked at Bitcoin? I'm like, what the heck is Bitcoin? And so he explained it to me, and I started first by looking at charts, because that's where that's the frame of mind I was in. And honestly, the chart was so volatile, I didn't even understand it. I was like, how could something move like that? And I made an assumption that it was a bubble. And this was just before the Mt. Gox hack. So I didn't buy any. It crashed, came down to eventually in the hundreds, right, from 1,200 USD down to I think it was like 130 or something like that. And I said, well, but I kept watching it because it was just still fascinating. And the first thing I did was start to mine, and actually mined Litecoin as well. I bought a little ASIC miner, and because I was like, man, I'm scared to buy this, but let's see how much it costs to mine. And I probably spent about $400 on a little ASIC miner, which was doable at the time. And now we're paying I don't buy miners with I'd rather trade $6,000 or $7,000 for a miner. Of course, Bitcoin's higher too. So anyway, yeah, that was kind of the gist. And I think so it was a trading asset. I wasn't doing a whole lot of trading back then. I was more mining, doing some selling. I think on the whole mining operation thing, I lost money. I didn't have a handle on the price action. At the same time, I was, I think at the time my best investment was Tesla stock. I mean, I had at that time made a lot of money off Tesla stock. So I was, was trading, but I just wasn't trading crypto per se. Over time, I started to really understand the value of decentralized networks. I was rabbit holing slowly but surely. Decentralized networks, understanding the monetary freedom, and going on and on. So I'm a lot more philosophical about Bitcoin now, even though it's also still a trading asset. It also belongs to my portfolio as a long-term hold as well. So I have sort of both portfolios. I actually what got me into the trading services. I was actually very interested in Ethereum because I sort of understood smart contracts more essentially, like more philosophically, as a means to create a decentralized financial service. And Bitcoin at the time had no inkling of that opportunity or that capability. And so I was trading. Some people know Ether Delta. I made trades on Ether Delta in 2016. Basically that was like the early DEX for Ethereum. I think it wasn't even that decentralized when it came down to it. But for people say, I have no idea, but I was basically interacting via smart contract. So and I was asked to join Elliott Wave Traders. Actually, ElliottWaveTrader.net is actually our home site. Seeking Alpha is sort of a sister service, and I was asked to join that team, the analyst team for Elliott Wave Trader, because I was a member, and I was posting Ethereum analysis and got a little bit of a following. And then they actually, a lot of the team was anti-crypto, but eventually they saw the interest in it, right? And like, well, there's got to be a service if there's this much interest. So I was asked to form that. Eventually, it swallowed my design career and turned it into a trading career. But yeah, that's kind of history. And that was 2017. So now we're going 6 years where I've basically left the corporate life, left corporate design life.
Okay, cool. So
that was a long-winded journey, but yeah.
Well, you have to get the information out there. Would it be fair to say then that you saw sort of Bitcoin more as a trading vehicle first, and then kind of also subscribe to it in the more fundamental sense?
For sure, yeah. I just saw it as a vehicle to short-term profits, to be honest. In the beginning, I mean, that was my mindset. I mean, even in stocks, I would do short-term trading and long-term trading, and because I was work a day, often things would end up being long-term. I didn't have really deep trading skills, but I just saw. I understood volatility. I understood a little bit of technical analysis. It was hard to wrap my mind around Bitcoin from a fundamental perspective for a long time, probably at least until the height of 2017. Even as we were rolling into the high of 2017-18, I was still thinking of it as a capability question, and you still had Ethereum with more capabilities, quote unquote. And I didn't have the philosophical belief in decentralized networks and censorship, issues of censorship in transactions. And so, but now I'm deep in, I have that as as I watch politics evolve in the United States, it just deepens my conviction around those concepts. But and it still is a trading vehicle for me, but I would say the other side deepened quite a bit over the last few years.
Mm-hmm. Yeah, and like you say, those charts. I mean, there's some beautiful charts you can see there, and you can just see how much potential there is in some of them as a trader. Right. Now, in terms of trading, so how did you get started with trading? And kind of the same question: what is it that got you into Elliott Wave Theory?
Oh man, you're going way back. So again, I got interested in trading. I mean, really as okay, I had this little design salary, and this was back when industrial design salaries were low. I mean, there was a kind of a design renaissance around, where design belonged in the corporate world after I got into the career, which was great for me. But in the early days, we had very low salaries. I mean, you would be better off being an accountant or even a waiter at a restaurant, honestly, at least in the United States. And so I was looking at supplemental income. And so I had stock classes in school, and it was just one of those concepts that I was like, man, people are doing it, then why can't I? I'm always a person like that. If someone's doing it, why can't I, until I find my limitations? And so I just got very interested. And it's also, trading technically is very visual. And again, I'm a designer. Like, that means I see patterns. And so there's an aspect of trading, I think, is natural designers. I know other designers I've taught how to trade, and they have a natural proclivity to see these patterns and consider what they may mean. And where some people need, they need to know the cash flow of a company, and they think of it from an accounting perspective, right? And so, and I have that capability too. I got an MBA later. Like, I'm fine with all the fundamental stuff, because I got a secondary degree in business, but I'm still a technical trader at a core. And then Elliott Wave, again, I was, when I struggled early in trading and I discovered technical analysis, again, because of designing, I took to it. And I was just reading everything voraciously, from like what's a cup and handle to head and shoulders, all those old style patterns. And I found, I don't know how I got the book, The Elliott Wave Principle. So we're talking sometime around 2001. So over 20 years ago, picked it up. It talks about waves that move in five, trends move in 5 waves. They correct in 3. Okay, that's a very simple concept. But all I had to do was look at a chart to say that was true, at least in some level. But it was very, very difficult to apply.
Mm-hmm.
And one day I saw this guy, Albie Gilbert. He is now kind of he's probably one of the more well-known Elliott Wave analysts out there. And I was following his calls on the S&P 500 index, a little bit on gold on marketwatch.com, reading it. And it was just crazy how almost predictive he was. And I was like, man, I could just read this guy's articles and make money. He's like, and we have a way of saying, okay, this blue box is the purchase zone. Starts breaking below the blue box. So we color code our wave patterns expectations. And, I don't like to say call them predictive because we get plenty of breaks. But the point is we can very, very clearly measure our risk. And so he was doing that on his charts. And so eventually I joined the site, ElliottWaveTrader.net. I was trading stocks and options and futures and all sorts of, I have a long history in derivative trading. Again, as an industrial designer, I'm basically trading derivatives as well. I had a certain level of experience on that. I was applying that to what he was posting as well as the rest of the team. And eventually I started learning the technique. We have tutorials. We have what we call a beginner's circle where we teach, people want to learn it. We just say, go read the book, which is the Elliott Wave principle, which is by Richard, by Prechter, which is not, he's not one of our staff members. He's been around a lot longer than Avi. And then, now join Beginner's Circle, which is a free part of the site, and take in the tutorials, and we'll get in. And my colleague Jason gives chart assignments to people and helps them through that analysis technique. But I think more importantly is how to trade it, because analysis is one thing. People think analysis, you get perfect analysis, you got perfect trading. That's not the case, right? You trading, because you're dealing with probability, you have to learn how to trade. So that's the other thing we do as well. So that's kind of the history. Again, got into the theory, learned it on the site, went from member to staff, again, because I was in a good position to start a crypto service within our services. And then, it's gone from there. Yeah, it's pretty cool.
Yeah, it's very interesting.
Yeah.
I've actually been following Avi and your own work for quite some time. I often use Elliott Wave analysis as well in my own work at Seeking Alpha. My question would be though, obviously I've seen Elliott Wave work quite well, like you say. Other times maybe not so much, like you said. Yeah. There's other stuff to it. Obviously the stuff you do is very purely centered on Elliott Wave. I wonder how much you think about fitting other technical analysis into like Elliott Wave and combining those two, or if you think about it as just something standalone that has to work by itself, or using other indicators.
I don't consider, it's interesting. It's an interesting question because I think I probably answer it different for other people. I don't think I think Elliott Wave is very good as a way to cover a lot of charts, especially for myself as a person running a service, and to quickly identify risk to reward on the chart, or to quickly say this chart's trendless. And there really isn't much advantage unless you've got like a range trading. I would say most Elliott Wave traders are trend traders or they trade pullbacks within trends. They're not like a range trader, which I think is a completely different skill. And if I was doing range trading, I would not use Elliott Wave if that was the type of trader I was. And I have members of the service that trade that way. And by all means, and teach if you feel like it using the site. But so my point is, Elliott Wave is not the be all end all. But I also use a lot of quants. So I've programmed some scripts, and I use a little bit of machine learning so I do it less on Seeking Alpha because I don't have the platform to do it so much. I've got one algo there, but I've got some quantitative algos that have been highly successful that I deployed on Elliott Wave Trader, and they have nothing to do with Elliott Wave. And it's funny because some members say like, okay, you're bearish Elliott Wave wise, but your algo says go long, and I just simply have my Elliott Wave account and my quant account, and sometimes they're together and sometimes they're not. But the point is, they're a different edge, and each of them are going to have a win ratio, right? That's unique. Sometimes that might share the same trade or have the same trade without different parameters. But I like having multiple edges in markets, and I'll tell you the algos do much better in choppy markets because Elliott Wave, when the wave patterns are not clean, then you don't really have high probability trades from that perspective. And so a lot of people don't understand that. But when it comes down to a trade itself, I try to keep the inputs as small as possible. I do not believe the concept that if you throw more inputs into a trade and they all agree, it's more probable.
Mm-hmm.
I think you just create for yourselves way too much input on a trade. Like if you're trading the MACD and RSI, for instance, which are the most simplest indicators anyone ever learns, right? Like you're not going to get much benefit by saying, okay, now I'm going to add ADX and I'm going to add some I don't know, volume even. I don't care what it is. You're only going to get start to get diminishing returns at some point, because at some point in time you go from added edge to decision crisis, which is, you have too many inputs to actually make a decision, because at any time it's just, you're going to get noise, right? Mm-hmm. Decision noise. So even when I'm doing machine learning stuff, basically most of the time it has like 3 or 4 successful parameters, and it's not going to be I don't expect win ratios. In fact, most of the time I trade with a 50% to 55% win rate. But the point is, my trades, because they're trend based, are often 3x the risk to reward, right? Or the reward to the risk, right? That's generally how we call that skew often. So I skew my returns, but my win ratio, I mean, it can wander. I can have a 30% quarter. I can have a 70% quarter. I have those, and quite often I land right in the middle, or mean revert, or whatever you want to call it. So that's where that's my suggestion to a lot of people is, I've seen members, I've got an algo signal, and we know the statistics of this algo. We have one algo we've had for 3 years, and it's on GBTC, which is the crappy fund from. Mm-hmm. I mean, it's not. I should say it's crappy. It's well designed, but problem is the discount thing. Okay, mm-hmm. So since we started the algo, that the GBTC has lost $3, but the algo itself has got $3 per share versus $36 per share positive in the algo since 2020. Okay, mm-hmm. And quite often it disagrees with Elliott Wave. Quite often Elliott Wave wins. It doesn't matter. It has its own edge. We have the statistics. I don't, and I always tell the members, like, if you want to filter the result, filter your trades in that algo versus what I say in Elliott Wave, you can, but you will miss some winning trades. I guarantee mm-hmm. you. It happened, and I had a guy that was doing that straight for like 2 months, and he said, "Okay, I see your point, because I just missed some big trades." And again, the point is, not my algo and showing it off. My point is, when you have too many inputs and you're trying to filter your trades too strongly, you basically just, people call it overfit. You just end up with an overfit that isn't robust. And trading, and really the notion of trading is best done when you have, a simple strategy you can write maybe maybe write it in 3, 4, 5 power, bullet points. This is your strategy. It's mm-hmm. well tested. And then the next thing is, when it starts to devolve or lose its edge, you optimize it or you throw it out. And trading is chasing, and I'm surprised my algo lasted 3 years and is still killing it. That's not normal. I've had to trash a lot of algos over the years that have had winning runs for a while. Mm-hmm. And you have to be really honest with trading, but trading involves constantly evolving your edge. I think the interesting thing about Elliott Wave is that it works, but it works if you have the right perspective. It never has lost its edge, but the edge is actually more psychological, because simply we're saying that here's a level of support, and mm-hmm. if we buy and scale and position carefully. In fact, I think Elliott Wave position size is a key part of winning with Elliott Wave mm-hmm. analysis. This is a general turning point, but as I tell people, when I've got a turning point on my chart, you need to position small until you're very close to that point where it breaks. And if mm-hmm. you position if you do that, and your position is not very large until you're at that breaking point, then your stop out is painless. And mm-hmm. so by doing that, you produce a high skew return. You have very few losses on the stop out, and then if they're working, hey, by the way, it went way up here. And so that's how Elliott Wave works. I think you can get the same thing out of pivot trading, or some people trade the boxes. I don't know if you know the box strategy. Sometimes it's called other things. Sometimes like zones and supply demand zones. I think all of those are very valid approaches. But if you start mixing them, you're just going to have this gobbledygook strategy. That's the main point I'm trying mm-hmm. to kind of build around, is simple inputs, like simple set of inputs for any trading strategy is the best way to go.
Yeah, I definitely see what you mean there. That sometimes less is more. And when it comes to Elliott Wave, the idea of risk management, I think it was one of your charts that I saw once where you would have like a triangle into the support zone, right?
Right.
Where
Yep.
you would
Yep.
say, yeah, the closer you get to that resistance area, the more you might increase your position, right? That's more or less
Support
how it
level.
would
Yeah.
work.
Yes. Yeah.
Hmm.
Exactly. Yeah. And again, that's the point is this is where the trade breaks.
Hmm.
And yeah, okay, if it goes halfway into the triangle and you don't have a full position, there is another setup coming where you can build on it, or you can just learn to be happy. Because to be honest, cash left in my account for another opportunity to me is a good thing. I don't always
Hmm.
have to have a full position, so that's the hardest thing I have when hardest thing I see in the people subscribed is to my service, that's coming down, and oh, we didn't get deep into support, so I didn't get that full position. We turned and go. That's a good thing. The trade is working. It started early. Okay, fine. Now let's see if we get another setup and pullback that gives you a tighter support level for filling the position. And if not, enjoy the profit because we didn't have to deal with that psychological challenge where it's starting to break support. Right. That's always a psychological challenge for every trader. I mean, I've been through it a million times now, so it's less so for me. But the only way you get there is going through that. And yeah, I mean just thinking about trades that way. I mean, actually, almost any strategy, I'll say, any strategy I'm using, I generally have a position system like that. When the trade averts against me a little bit, then there's usually a point where okay, this is really not working, and it's
Hmm.
a hard point. But I often enter trades partially, and if the trade goes against me, well, I'm just getting it cheaper. And it's again pre-planned. I'm not averaging down classically where okay, this trade's against me, I'm buying more. This trade's against me, I'm buying more. No, it's
Hmm.
pre-planned. This is the area that I'm scaling in, and then below this, it's the trade is absolutely not working, and I got to stop out completely.
Hmm.
So, and I do that with almost, and again, even in my algos, if the algo says enter, and the next bar is down, well, that then I'll enter a little bit more. That often works quite well. And I even set up a recent algo in our service, pretty new. We'll see how it goes long term, but I actually give scale in points along with the algo signal. Just say, hey, here's the stop. So that means you might want to take some secondary enters if it goes against us for a short period of time. But there always is a breaking point as long as everyone realizes that.
Hmm. Now, I wanted to change the subject a little bit because you did touch
Yep.
on this briefly. You talked about the crappy Grayscale Bitcoin Trust, and this
Right.
was one of the questions I had for you. Basically, yeah. What are your thoughts on GBTC? Is that
um,
a? I mean, you said your
well, yeah.
algo tracks it. Is that something that you would own, or would you recommend not owning it?
I was an owner of it, and I was an owner for a long time. I still own it, but I've been cutting my position and trying
Hmm.
to do it gracefully. I think the problem is we lost the mechanism for it to get back to par,
Hmm.
and unless it gets turned into a spot ETF, it's not going to happen. And I don't think
Hmm.
that's going to happen under the current regime in the United States. So, especially Gary Gensler at the SEC. So, um, I don't think there's a problem with its basic design. I think that we've seen, and again, I don't know the inside halls of Grayscale Investments, but I think we've seen them be a good player in terms of custody and all that stuff. Never mind the Genesis issues and all of that. I mean, the Grayscale Investments itself, that subsidiary of the company, has been good on the custody side. We haven't seen them. They've been one of the largest Bitcoin holders in the world, and we haven't seen any of that Bitcoin leak, as far as we know. Um, so I shouldn't call it crappy by design, but what the market has done to it, the arbitrageurs that were selling the premium when it first came out. I mean, I thought about joining that arbitrage game of giving getting shares for my Bitcoin and then selling it for premium. I was always very tempted to do that, but yeah, we're just left with it's like a hobbled asset. What can you say? I still trade it with my algo, but those are short-term trades, so they really don't count. I still hold a little in my retirement accounts, uh, just to try to get a graceful entry. So I trade it back and forth and make short-term profits off of it at various points in time because I have a pretty good handle on the chart most of the time. It's got a little bit scary in 2022, but it's been pretty good this year. Again, the algo helps as well. But me trading it doesn't say it's a good thing. I generally tell people BITO, BITO is better. Granted, everyone has to understand what's inside that, which is futures, not spot. That's concerning for sure. But at least we can say that, hey, this is an asset that's 99% correlated to Bitcoin on a day-to-day basis, right? That's a lot better than saying, okay, really, I mean, GBTC has a mind of its own on the market. I mean, there's a relation chart-wise, but it's not a one-to-one correlation. It's like it's got this mind of its own, and that really is that like 50% discount that's going on inside of it. Which basically you can say half correlated to Bitcoin, right? Half of its market price is due to Bitcoin, the other half is due to the mind of the discounters or the discount stuff. Yeah. So
I mean, during the more bullish times for Bitcoin, we have seen GBTC trade at a premium.
Right. Yeah.
So are you saying that you don't really believe that premium would come back, perhaps in the future, and that that might be something to play?
I think it's possible. We certainly saw it shrunk, but I'm not clear whether it shrunk because of market sentiment, really around GBTC, or if it was simply the SEC lost the lawsuit that Grayscale has waged against the SEC, and it was excitement over that. I think it's too early to say. I mean, certainly in periods of euphoria, we saw a very high premium, right? I mean, maybe at that time we get it back to par. I have a really hard time. I mean, didn't we get to 100% premium at one point in time, like back in 2018? I think it was nearly double the value of Bitcoin. And someone's going to correct me. I mean, I just remember it being very, very high, and I think ETHE was even bigger versus Ethereum, but went into a faster slide. And so I think the mechanism for getting there is a difficult one. I mean, you really are asking retailers to move the needle of that thing back to par. Generally, like ETNs are often discount to the NAV inside. I think it's very similar. I mean, I think if you're a closed-end fund and you have nobody buying the shares to arbitrage it, and then basically letting off when it goes to premium. I mean, really, you don't have a managed NAV. You don't have a mechanism for it to crawl back up. And so I just think it's a difficult one. Like I've been thinking about myself, is there any way to arbitrage this so we can help it along? Because you really need arbitrage as a mechanism. That's how things find fair value. They found fair value by arbitrage. And I don't see the mechanism. I don't see the incentive to do that in the marketplace. Yes, it might be the retailers. It might be retailers getting so excited, but now you have a competitor, BITO, and you have other trust fund competitors as well. Like I can't remember the names of the funds. Haven't never ever traded them, but there are other with the same design. And so now you got to spread that market that money around, and I'm just not sure retailers are able to do that right now.
Yeah. Now, in terms of the best way of owning Bitcoin, I mean, obviously, if you're trading and stuff, you need to probably use those exchanges. But I guess you would also maybe subscribe to the idea of the old saying, "Not your keys, not your crypto." Sure.
Yeah. No, for sure. I have dedicated Ethereum and Bitcoin holdings that are multi-sig, off, not on exchanges. I got the keys. I mean, I'm always evaluating my security. It for sure. And so I differentiate my trading assets versus my long-term assets, and everything I'm trading is, and in fact, even more and more I'm trading CME futures because, out of my brokerage account, and then to hedge my Bitcoin holdings, I'm sometimes trading that way. So I'm not even touching the exchanges at all.
Now, I wanted to get back into Elliott Wave because, of course, that's something that I've also looked at a lot. And I wouldn't quite call it a debate, but where do you stand on the idea of using logarithmic versus arithmetic charts? When
I know crypto, you cannot see the waves properly in a linear period. Like you really can't. Like anyone take a Bitcoin chart, put it in linear on a weekly chart, and you see mountains, right? Yeah. And if you put it in a log chart, you see a clear trend, right? Yeah. Like Elliott Wave is a trend analysis at a core. I think that plays out in actually every asset. I only when I feel a little different is Forex, because they tend to be actually ABC structures. They tend not to be 5-wave structures except for a short period of time, and they tend to be sort of nested ABC structures. So it's not even really pure Elliott wave. You get in 4x most of the time. But a linear chart tends to work also because the function of how important log linear is a function of how volatile the asset is. If something, if a third wave you can have in crypto, well, let's say take a non-volatile stock, and its third wave coming up might get you 30% return, and then the third wave in Bitcoin, like if we really get even just the fifth wave up to 125K, which is my target, that is now what, 4 or 5x, close to that, right? That if you use fibs the way we use it, you will not get a projection anywhere close to 125K.
Yeah.
And the only reason we get 125K is because we use linear log fibs, but it has played out. It has played out for years for me. And I'll use a clear story. So this is back when I was really trading Ethereum more than Bitcoin in 2016, and I was a member of Elliott Wave Trader, not on staff. And I was still learning Elliott Wave at a deep level, and I was using linear fibs, and we were coming out of so we had the Dow hack, and then I don't remember what the low was, $6 or $7 in 2016. I don't remember, something like that, and then it broke out at $10, and I used linear fibs and I had projected a target of, I think, $30 or something like that. Okay. We got to $30 and I saw there's a lot of typical technical things you see at fifth wave targets. One, it didn't look like it had even finished the third. Number two, it didn't have any of the technical aspects that you would expect near a top. And then I had a fib target and it kind of started to zoom past it. And then at that same time, one of our members did a really deep dive down on the very important aspects of log fibs. Like if you do linear fibs on the S&P 500 over the last 100 years, it won't work. At least not if you use fibs and fib targets the same way we do. You can use linear on a shorter time frame, but you can't do it on a 100-year chart.
Right.
The span. So he went through the 100-year chart of the S&P 500 and showed the importance of log fibs, and the point is that, let's say you're looking at the 1.618 extension, in log it will mean the same thing on every time frame. Meaning you can do 5-minute chart, 10-minute chart, 15-minute chart, and if you're using log fibs, you get similar hits of fibs at any time frame. If you're working on linear, all of a sudden on the long-term chart, you got to talk 500's extension, 600 extension, and it just doesn't make any sense if you're trying to stick to a method. Start to you're basically apples to oranges on your fib extensions. That's the main point, and no one's going to get this on the podcast if they're not deep into Elliott Wave. But you can apply the method by time frame. So anyway, my point was, after that talk, I was like, holy crap! I take the same setup, I apply it in log. I don't get 30 as a target, but the next big fib is 1300. And then after that is like 2000, and after that is 2500. Now, I maintain that Ether broke down after a C wave in 2017. It did not give us a full 5 waves. That can be debatable, or you can say that you can even say that it's working on its 5th wave now. But regardless, and I challenge that notion too, but irregardless, the next key fib was 1300, right? Where did we top? And we were like 1400, right? In 2017, something like that. I don't remember exactly what it was. Or I think it went into 2018 with Bitcoin, topped in 2017. I would have never been long between 30 and 1400, but I was, if I had not had that realization, if I had not been on the log chart. I would have, 1700 in terms of percentile gain, I have never outdone in my life yet in terms of a yearly gain, right? I won't even talk about it. It was life-changing. 2017 was life-changing. Now I knew we had come into a top in Bitcoin. I was running the service. I had lots of coins and all these alt wallets because I was secure back then. And I think at one point in time I lost 6 figures over 24 hours because I was just moving coins out of wallets and covering my service. So I wish I could say it was, it was life-changing. At the same time, if I wasn't moving all those coins around, it could have been ever more life-changing. But regardless, my point is, because I don't want everyone to think I made myself ultra wealthy at that time. But my point is, I would have been out of Ether at 30 if I was using linear fibs.
Mm-hmm.
And I would have just gone home and I would say, okay, we're near a top. And then I just would have watched it zoom all the way up to 4 figures. Instead, I got out at 30. I saw that guy's article. I went back to my fibs. I went to log and I said, holy crap. And I went very long. So anyway.
Good thing you saw that article. That
Yeah.
changed your life. Now, the reason I was asking is because I think when you do use the log, like for example, looking at Bitcoin now, depending on how you measure certain structures, I feel like you get very bullish outcomes, which sometimes I feel like are not very realistic. You know, you get like Bitcoin going into like 500K or even 1 million.
Yep.
Is that something, or you just like, well, that's it. Those are the fibs.
What I always tell people is those are the moon counts. Now, I would say we've seen since I started in 2017, we've seen Bitcoin hit all its major fibs.
Yeah.
So it's with Bitcoin it's harder to challenge. But I would say with shitcoins or altcoins, whatever you want to call it, even Ethereum, we've seen it miss those big targets.
Mm-hmm.
And I don't chalk that up as Elliott Wave isn't working. No, because Elliott Wave also told me when they were going to miss and told me to get out, right, to cut my positions. So it works. It works as a risk management tool, whether you hit your targets or not, whether the support holds or not. That's just important. Like, you know, I trust the supports from Elliott Wave, and when they break, that's important. I got to cut my position or get out, depending on what support we're dealing with. So, is Bitcoin always going to hit those fibs? You know, I really can't say, right? Like, I mean, I think Elliott Wave has some predictive qualities, but I've seen enough targets miss. I've seen enough, especially shitcoins. You know, you think they're going to go 5 waves, they top in the 3rd wave, which aka C wave, and then they die, right? So, you know, that's okay with me because I trade those C waves. You know, I trade the C waves, and I get as much juice out of them as I can before they start to fail. I mean, that's how I trade, and over time, I've grown very realistic about what we can get out of an altcoin before they die. Even with Ethereum, I'm very realistic about my projections going forward in Ether. I have very bullish ones. I expect 10,500 right now in the current cycle, as long as 1,000 holds. But and again, it's always if this then that. But I'm also realistic that because it topped, in my view, a C wave in 2018, Elliott Wave loses a little bit of its value, and it's a little bit easier to trade Ether on a shorter time frame than that major weekly chart, where Bitcoin has just hit every milestone in its weekly chart, and you know, it takes about a break of like $3,000 to like say I'm not getting 1 million. You know, it takes a break of 3,000 for me to doubt 1 million. And the thing I don't say is by when, right? Because maybe 1 million comes when I'm 80 years old, right? So I think the point is that I trade long-term counts as a roadmap to help me work the trade at a lower level. And then, you know, okay, that would be nice. I'm not holding any altcoin out for its crazy moon targets. No, I'm trading smaller time frames. I'm snapping off 3x's, 5x's. Sometimes I got to get out after 30%. Sometimes I got to get out after a small loss. I'm working the smaller time frames. And then, yes, if after it does X, Y, and Z and it sets up again, okay, now let's talk about the next target, right? It's just swing trade by swing trade. So just to be realistic, because I've seen way too many altcoins especially fail. And again, Ether to me was a big failure in 2017. People may not think it that way, but from an Elliott Wave perspective, and my perspective, depends on, I mean, I can, my colleague Jason sees the 5th wave as now. I have a hard time seeing it for various reasons. Okay, that's fair. You know, I can give that to him, but I think it should have happened in not, you know, maybe 2018. And it was just, I think there's an exogenous thing that happens in crypto. It's that Bitcoin sucks the liquidity out, right? As soon as Bitcoin tops, all the liquidity starts jumping out of the market, and then altcoins can't go anywhere. And I think that's what happens with altcoins. They're great as long as Bitcoin is performing. Now, you know, maybe one day they stand on their own, but I think it'll be very few that stand on their own over time.
Right. Sorry. So you're saying that because of that failed move in 2017, where do you stand now on Ethereum? You see that going lower?
No. I'm bullish on Ethereum. I see it going to 10,500. I'm only saying that when you're dealing with ABCs, structures, and then again, that can be challenged.
Mm-hmm.
Dealing with ABC structures, the predictive qualities of Elliott Wave analysis reduces a bit.
Mm-hmm.
So I'm very reluctant to say after 10.5 what the target should be. I'm very much going to say, okay, let's hit 10.5, and then let's see where it retraces. Let's see where Bitcoin is. And it'd be a little bit easier to talk about scenarios in the ether after 10.5. And that's because of the ABC structures, where Bitcoin is mostly done what I've expected since the top in 2018, even more than that, the bottom in 2018, except that sometimes it took a little slower. Like, I would have rather seen it shoot up to 125 just like everybody else in 2021. Right. But from an Elliott Wave perspective, it isn't so bad to take a detour as long as you don't break support. And there were two levels of support: 16K, which it kind of tapped below it, but it's come up, and the second one is 3,000 region. We got others below that, but so is the problem is when you're on Twitter and you post a setup, and then someone says that didn't age well, right? Or that one failed, and then they're not paying attention to you anymore, and then you got there like a little bit later. Okay, whether the situation there is, okay, either my Elliott Wave count was wrong, or it put in another consolidation inside, right? And it can be both, right? It depends. It all depends. And that person's gone, right? They're not following you anymore. And that's the funny thing about forecasting, and it's like, and that's why I always avoid timeframes, because, like I've said, Elliott Wave, Bitcoin has always hit its targets. But if you're picking on some post I made on Twitter at some point in time when Bitcoin was moving very aggressively, that little, smaller time frame may have turned out wrong, right? Mm-hmm. Smaller time frames turn out wrong more often than larger time frames in most asset classes. So anyway, yeah.
Yeah, well, I mean, it's definitely a widespread problem nowadays. Judging people on, some tweet they made, and not on the whole content of what they share.
Exactly. Yeah. Or I mean, I think I always say my value is in how to trade Elliott Wave. I think that, versus at least, I usually get compliments on me teaching how to trade and use the analysis versus me being such a brilliant Elliott Wave analysis that I'm always right. Mm-hmm. Like, and I'm more, the reality is most professional traders trade close to a 50% win rate on a long-term basis, right? Mm-hmm. Could be 55, could be 53, could be 56. Most of the time I would say, quant trading and high frequency trading is different, because they actually gear that to win rate. But most of us are, I'm more interested in getting close to 50 and then being 3-1 on my returns versus my risk. Mm-hmm. So, it's just more easier to accomplish that, and you can't do that if you don't take a stop when you need to, and when you're wrong. So anyway, yeah,
absolutely.
That whole thing's funny.
Twitter's hilarious, yes, especially when it comes to crypto.
Yeah.
So now, in terms of Bitcoin, you were saying then, would it be safe to say that until that sort of low that we breached recently is at 16K is broken, would you say that the bottom is in, so to speak?
As long as that holds, yeah. I mean, actually, now I would say 18, because it's the old, like, okay, support needs to move up, and 764 retrace of the entire range. I don't think that's a perfect support. But if you take, it's around 18, where you take the range that we've seen from that 15,500, a log 764 is around 18 roughly. But that's where I would get concerned. That, I mean, just probability would say once the 764 goes, that's sort of the end of the line, and generally the whole position is, or the whole structure is invalidated. Just generally, I mean, every once in a while you get a poke below 764. I've seen Bitcoin go to the 88. Right. But it's like 99% of the time, if the 764 retrace breaks, then it's going to take out the low. And so generally, I often look for a spike in reverse. But if we don't get it and we start consolidating below, then I get out of my positions. And that wouldn't mean that I got out of Bitcoin. It would just mean that I cut my aggressive positions. Because again, I was buying Bitcoin down, as we were going down in 2020, 22, but because I knew we were in a bear market, I was just buying. I tell people it's generally around like 0.5% of my free cash flow every month, right? Mm-hmm. Like that's a very safe, like, who cares? I'm just adding a bit Bitcoin as we go down. I'm not taking any aggressive long trades. In fact, I took some shorts along the way. That's very different from saying, okay, I'm just buying all the way down, aggressively. At some point in time, you're just going to run out of money. And so cash management's all key and all that. But so if we break, my point is when we break 18K, I'm not going to get out of I do have, like, my trading accounts are going to go to zero, but I still have my long-term, multi-sig wallet, cold wallet holding Bitcoin. That's not going anywhere. And then I will focus on adding to that, those cold wallets by buying, I might buy $5 a day. I might buy $100 a day, whatever, whatever my cash flow looks like. There's a lot of other asset classes I do similar, some, indexes, various stuff. Some people make fun of me because I got into wine investing like a few years ago, and it's been very well for me. So there's a lot of asset classes that are important to me, but I mean, the main thing is like cash management. When you're in a bear market, you gotta slowly manage your cash as you go. Otherwise, the biggest lesson I learned about trading is I called the bottom in 2018, but I was not in a financial position to fully take care of it, to fully make use of it. I didn't do bad. I did great, but like I've always said to myself, okay, like since then I've said, okay, what am I going to do in the next bear market? How am I going to get in low? And my conclusion was I got to be a little bit lazy and just say, okay, I'm gonna hold a lot of cash, but I'm gonna slowly trickle that cash as we go down. No aggressive longs, no leverage. In fact, leverage may be applied to the short side to hedge what I've been accumulating. And man, I was really, this is like the third bear market I went through in 2022, and I was absolutely happy with my performance. Again, I'm not saying all my calls were perfect. I'm just saying that my trading, the acumen of being really careful was, it was just excellent. And so when we were going up, when we came off 15.5, again, I didn't expect it to come off that. We reached my key support. I figure, but then we started coming up. I was like, well, I'm making money because I had just accumulated into that low, slowly but surely. Had more sats. So anyway.
Yeah, absolutely. At the end of the day, as long as you have that conviction, you've got to be able to just play the long game and accumulate.
Yeah.
Now, you talked a bit about having other investments, and that's also one of the questions that I wanted to ask you, because obviously, in terms of analysis and trading, you're a crypto guy, but I would assume that you also have some other investments. You just mentioned, for example, the wine. How do you see crypto and Bitcoin fitting into like a more diversified portfolio for investments?
Yeah, it's funny. I gave all my members like a whole webinar devoted to how I look at portfolios. So I look at asset class. Cash has got to be an asset, right? You got to have cash. Yes, cash is losing value, but how are you going to take charge of opportunities without cash, right? I have not classically viewed bonds as an asset class, but in a high interest rate environment, they are great. So I have been buying bonds of late because as soon as they drop interest rates, those bonds are going to fly. And then I'll probably be done with them as soon as they get back to zero rates in the United States, which I imagine we will again. If we got a Fed anything like what we have today. So now bonds is added to that. General stocks, so tech index, NASDAQ, and then small caps, the Russell 2000, as well as SPX. To keep it simple for some people, I just say SPX, general stock market exposure, gold, and I have that in the form of mining share index, GDX, as well as a little bit of physical metal, not a lot, but I've been looking at building that up because it looks like we're in a gold bull market right now, and I expect that to continue. And then Bitcoin naturally, and Ethereum a little bit less so, but I consider Ethereum viable long term. And again, my value there is, if the crap hits the fan where our financial service is going to be, it's going to be on Ethereum right now. Maybe one day it's on Bitcoin, and there's some movements in that regard. Let's see. I'm trying. So and then there's a lot of alternate assets that I've grown in interest, and I'm still trying to place them again. Wine and whiskey. So I've been working with an outfit in London for trading whiskey. My best return in 2022 was Scotch, all housed in London. And I'm not talking about unrealized gains. I did trades, and the average is about 20% return on each trade. And we're talking about an asset. There's no volatility. It's just like you put whiskey in a barrel and it just ages, and it just becomes rarer and rarer. And to me, it's almost like a miracle asset class. But I'm not telling everyone to go out there and get some. But honestly, I'm having a hard time getting some now. It's like I think people are onto it right now. I've just added wine through an outfit called VinoVest in the United States. Just starting it. We'll see how it goes. I've actually done a little bit of trading. I've been learning about wine. I mean, I've always drank wine, but I never drank fine wine, investable wine. In fact, I never have today. I mean, I'm just, buying, drinking from a $400 bottle is not really my norm. But I own some, and they're all actually housed in London as well. Even though it's a U.S. firm, it's housed in London because that's where wine trading is. And those are wine and whiskey are great non-volatile assets. So like they tend to they get rarer as you go. Mm-hmm. I've been playing with rare fractional shares of even NFTs and exotic cars, and I think those markets are interesting. I think they're a little too illiquid to really make a return, mm-hmm. but they're also again non-volatile. So like the S&P 500 is going down; they're going flat to up mm-hmm. in the last couple of years. So just diversifying around, and then I think that I don't always think this way, but if you want to just be an investor that doesn't trade, and you want to take part in volatility when it happens, just lay out a plan, maybe along the asset classes I shared, maybe you take some in, take some out, and just rebalance. And I tell you, I was, so I have a friend in San Francisco that she wasn't clear about investing. I said, well, check in with me every once in a while, and I can help you. And I just gave her like a layout of ETFs, stock ETFs, mm-hmm. And again, same kind of outlay I just gave you. What stock exposures, big cap, small cap, and then just a little bit of biotech. She's young. She's quite a bit younger than me, so she can go a little more volatile in her mm-hmm. stock account. Told her to get a little bit of Bitcoin, but because I was worried about her managing the security properly, told her not to go crazy there, and all of that. And man, she's done fabulous. I just said, well, she sent me your portfolio by email, and I said, well, this one's getting heavy, mm-hmm. let's put some of that over here. And honestly, that act of if you simply give yourself a plan, and I generally kind of have this, but I'm even bigger on this now as I get older, is just say, okay, like I'm gonna have 15% gold right now. Oh, let's bump that up because it's a bull market in gold right now. Okay, so let's bring that to 25, and then on top of that, maybe when things vary by 5% to your targets, just rebalance. And you can go a long way. I mean, that's not exactly how I trade because I see too many opportunities on a short-term level, and then often take that income and put it into my long-term. Just okay, I just made let's say I made $5,000 in crypto in the last couple of weeks. Okay, let's take that money. I want to keep that money, so let's put it over in wine. Where it's not volatile, and my wine exposure is like a little bit low for the rest of my portfolio. So I'll do that a little bit, but the complication with me is I'm using short-term money and then moving it over, or sometimes I keep my short-term money because I see more opportunities coming. Mm-hmm. I'm a lot more complicated, but for a simple, just someone who doesn't really want to trade actively, I would just say for those people, if they take a crypto exposure into their portfolio, don't mess with shitcoins. Like if you don't watch them, they will screw you over. Mm-hmm. Like altcoins can't be traded or invested in unless you are watching them like a hawk. Yeah. How many shitcoins have I owned that I did as a investment and they're down 98%? I mean, fortunately, no big money for me because most of my money goes in Bitcoin and Ether, but I have a few of those. I mean, I like what they're trying to do, but Star Atlas, I have a player in the game. Okay, they've never launched the game except for a couple trial. I don't know if you know Star Atlas. It's on the Solana chain. Okay, the token, I got the token at 20 cents and now it's 0.003. So I've got, it's basically a game token for play to earn, right? Like mm-hmm. I'm actually interested in the game, so I kept it, but my position is down. I mean, I think it's like $1,000 after all the return I got from their staking and all that stuff. I think I'm down about $1,000, but, But it's just like no altcoin has ever done much for anybody long term, mm-hmm. except for maybe Ether, right? Like, I mean, name an altcoin that has repeatedly outperformed Bitcoin, and Ether has barely. It's really not. If you look at versus 2018 peak, we're only mm-hmm. close to it, right? Or did we even breach it? And then I think BNB was the other one. BNB has solidly beat Bitcoin over many years. Will it do forever? I don't know. It's also got an ABC structure, best I can tell. So, yeah, I mean, I think people should make it easy on themselves and just accumulate Bitcoin, Ether, and then turn Twitter off. And unless they want to trade, unless they want to develop the skills, then they're going to have to make it hard study, and they're going to have to work on the craft. and they're going to have to turn off Twitter also because most people on Twitter are no good. And they're going to have to get some mentors, and they're going to, anyway. And I don't want to over promote, but I mean that's one thing we do. But still, people need to just check it out, and then if it doesn't work for them, it's all good.
Mm-hmm.
But
yeah, absolutely. You definitely have to turn off the noise sometimes when it comes to investing, and listening to too many. Like you said before, too much output is not necessarily a good thing.
Yeah.
And it's very interesting what you mentioned about the wine and the these kind of alternative investments. I feel like now is a time when people maybe are kind of through technology, it's getting a lot easier to get exposure to those, and it's definitely something interesting. Personally, I've been thinking about watches as well. As those tend to be quite if you know what you're doing, you can collect them and be quite good investments. You mentioned kind of a couple of things already, like the idea of gold being in a bull market, rates maybe going back to zero. Could I get your take a little bit on how you feel about the macro environment moving forward, let's say in the next 2 years?
Yeah. I mean, I think people should listen to Lynn Alden. I mean, she's an adjunct to our team. I mean, she's got her own thing going on, but she pays a visit on our site occasionally. I mean, she's brilliant. Let me gather my thoughts, because that's really not beyond my expertise. I mean, I'm going to look at charts too. So I do see a bond rally developing. And I think that's the market saying, I mean, if you actually look at charts of short-term Fed rates versus bonds, the longer bonds only have sort of the tie to short-term rates is very secular or cyclical versus being sort of word for word, like Fed lowers rates, long bonds, go up. Like it isn't that one-to-one, or it might be a very brief correlation. But the truth is, the only thing the Fed really controls is the short-term rates. So when you look at bonds, you have to really more watch the market. How is the market pricing bonds? Particularly, for me, it's the chart structure. And right now, we've got a developing bond rally, which is going to lower rates it's going to lower rate in mortgages. It's going to lower rates because at least in the U.S. The mortgage rates are tied to the 10-year bond, as I understand. Certainly, I'm buying a house, so I've watched mortgage rates, be pretty correlated to the 10-year bond. Someone else can probably correct me. It's actually a 20-year bond or 5-year or whatever. But so I see that developing. So I see mortgage rates coming down. It's a really interesting environment because I've been through the recession after the tech wreck. I mean, I remember the recession in the U.S. after the Iraq War, the first one. And then, because I remember that, and I was ending high school at the time. And then I remember the next one that was big to me was the tech wreck, and I actually lost my job after the tech wreck in 2000. It took until like 2023, I think, for me to actually lose my job, or 2022, and I got one maybe after 6 months. And then finally the financial crisis, which that allowed me to buy a house very cheap, I remember. And then so I'm just trying to think. Everyone is such a different character. So if you listen to people, right? Oh, we're in recession, but really, like, we haven't seen any of the characteristics of the recession that I remember, where people were losing their jobs. I mean, and the job losses now, at least in the United States, are white collar. So you can see me kind of dodging predictions about macro because I'm really not the person, but I find it incredibly fascinating. I think some of it, the COVID thing. I think some of the we have some interesting, like, we have some of the inflation that the Fed is trying to fight is not monetary in nature. Because some of it is, we go to a restaurant, it's more expensive. Well, a lot of, at least on the West Coast where I'm at, a lot of the restaurants are immigrants. They could be, most of them are probably from Mexico, some from Asia. And, we basically during COVID cut the immigration down big time. Even still, people yell at Biden for his immigration policy because he's just letting everyone through the border. Well, it's not really true. There are a lot of people at the border trying to get through, but it's, unless they're jumping the wall themselves, or jumping through the gate themselves, it's a slow process at the border. And we still have a lot of COVID era policies, and I don't know where we are in detail, but you can still see it. I mean, where I'm at, you can see it in the lack of construction workers. You can see it in the lack of restaurants are always understaffed.
Mm-hmm.
And even I mean, we experienced some of it in the medical situation because COVID burned out medical staff. So but then at the same time, we got layoffs at Google, layoffs at Amazon, layoffs at Facebook. So the recession is at this kind of white collar level in the United States, at least. Again, I can't speak for the globe. And then we're seeing a little more for the first time some wage power from the lower level labor force. That's just a very interesting turning. I don't think we've given back the wage disparity that we've had in the United States that's been growing. In fact, I expect that continue to be a trend, unfortunately, and maybe even more so as AI develops and all of that. But yeah, I mean, it's a weird environment. And, I'm purchasing this house. Well, I had to bid over, and I probably will, I hope I don't pay for that. But I mean, when we went there, we weren't even the highest bid. We just had better terms. But we had to, up in Seattle. I mean, it had come down, but summer's coming and people are buying houses again, and that just has to do with the shortage of housing in the United States. Yeah. And so you have this weird difference of bad economic conditions with supply pinches, and you don't have, are we going to get to a really bad spot where people lose their jobs, but prices don't come down because we've got bad supply situation, right? On all fronts, whether it be from houses, or eventually, are we going to see the houses come down? It's a weird one. Now, okay, let's talk Bitcoin, right? I think that, especially on Twitter, and I think even macro people give macro way too much credit to actual pricing in markets. And I found it really funny that people would make assumptions about Bitcoin prices back on micro. Well, Bitcoin hasn't existed in any hit point in history that is like this. How can we ever say so much? And it got a little ridiculous as, okay, from my perspective, okay, I figured 16,000, the way it was going, breaking 15,500, I expected it to keep going. So freely admit that. But of course, at some point, I'm very good at turning around and saying, nope, I was absolutely wrong there. Okay, we broke my support, but only by $500, and then we came back up. Okay, I gotta give respect to price action. And but even still, like 3 weeks ago, I was hearing podcasts saying, here at so and so podcast, we're here to help you through the bear market. And I'm just like, is it a bear market? Are you sure? And I'm not saying whether it is or not when I'm making that question. I'm saying, are you looking at price at all, or are you still looking at the economy and assuming that the economy is playing into Bitcoin prices in some way that you actually have no historical backing for expecting this or that? Because we just haven't seen Bitcoin exist in this environment.
Yeah,
it's not logical. Like, I mean, I think there is validity in like excess liquidity. When the market has a lot of liquidity, it kind of finds itself into Bitcoin.
Right.
That's all. That's all. Like, those are all good theories, but until you have a historical way of assessing price forecast expectations based on your macro reads, liquidity, etc., it's just theory. It really is just theory. And I mean, I've seen it over and over. People are saying, okay, the Fed, if the Feds raise rates again, Bitcoin's going down. Well, they haven't stopped raising rates, but Bitcoin is up almost 100% off of the low, right? Almost. I mean, it actually did get to 100%, right? Or
it did double the price.
Peak to trough. So wait, what are we saying about, the race never came down?
I mean, true. I mean, there's definitely other narratives coming into play. I think, especially at the beginning of that year, one of the big macro narratives coming in at that point was not about sort of the US liquidity, but rather global liquidity.
Sure.
So I know, like, the Bank of China was at one point did a bit of they lowered their interbank lending rate. So there was, if you look at the charts in theory, so the global liquidity did go up a little bit. So to an extent, there was a bit of a correlation, I would say. Yeah. And I mean, we have seen it before, right?
Keep on. Yeah, keep on. I don't want to interrupt.
No, you say, I mean, Bitcoin, it's not I mean, obviously it's a very young asset, but we did get some kind of a correlation. Obviously, there was the COVID crash, Bitcoin crash. I mean, and then obviously with all the QE and the liquidity, it went up. I mean, I think this is something that for me, as someone who does use a lot of Elliott Wave Theory as well, but I always find like you have to ground a little bit on the macro as well. I know that, for example, I don't know about yourself, but Avi Gilbert is very adamant always about talking about how basically the events just, completely uncorrelated with the charts guiding everything. Now, obviously, again, as someone who does use Elliott Wave Theory, I do find that sometimes a little bit hard to believe.
Yeah.
Like hard to kind of, put those two together. I don't know how you feel about that.
Well, sorry, repeat, because I had somebody text me. It was important. State what you said again. Like, what do you have a hard time putting together?
The idea that kind of the moves like in Bitcoin or stocks can be just completely unrelated to the events, like whether it be like something macro or maybe like stock earnings. And I know that Avi Gilbert, for example, is always very adamant. He's saying, "Oh well, look, the market said this, but actually, price went another way." But I find that there are some correlations, especially sometimes when you look at, for example, when obviously after COVID, when we got all that stimulus, Bitcoin did go up. Was that because of excess liquidity? Well, perhaps there's an argument to be made there.
But I think the question is, can you trade that correlation? So I made a long article around. I made a whole article for my own subscribers called "Correlating and or is it correlating and was it correlation and correlating or something? I don't know. It had some other. It was another C word. It worked at the time. And the question is not to me whether correlation exists or not.
Mm-hmm.
It does. Okay. The question to me is whether you can use it for a trading edge.
Okay.
Okay. So like if you it's like again, like you go to earnings. Okay. Like earnings for stocks. Every stock investor knows that earnings is a big deal for every single stock, right? Mm-hmm. And how many times have we had bearish earnings and chart flies, or bullish earnings and the chart dumps, right? And for the life of me, no talking head or person that's focused only on the event themselves has any way of explaining it except making it up. I mean, I just can't. And and it's obvious that the earnings was important because it moved the market. But if you had sat there and made assumptions by the earnings estimate, maybe someone inside the company going very, very deep could have cheap. But I've even found the most silliest explanations for why this, bullish earnings when talked to them. Oh, there was some little sentence in the CEO's thing where oh, that must have been what dumped the stock. Okay, that's silly. It really is. And so I think I agree that correlation is a thing, but again, the question is whether you can get a trading edge on it. And the other problem, like let's take Bitcoin correlation. So in 2018, at least my subscribers, and I think generally on Twitter, people said it was correlated to the S&P 500. Okay.
Good.
And then as we went into like, I don't remember what it was in 2019, maybe still S&P 500. And as we went into 2021, I started hearing the NASDAQ. Okay. As we started to go into late 2021, 2022, it was the US dollar index. Okay. I don't even know what people are saying in terms of correlation now. But if you're doing that, this year it's S&P 500. This year it's NASDAQ. This year it's the DXY. Now it's whatever it's, maybe it's bank failures they're correlated to. I don't know. You don't have a strategy.
Right.
To be honest, if that's your macro, that's not very macro because you're changing it you're basically looking at statistics and saying what's correlated right now. And that has no predictive qualities going into the future since it's going to change anyway, right? That's my problem. That's what the problem with, I don't know if you're very well versed in the lumber correlation to stock. So when lumber comes down, it correlates to it's actually a leading indicator of stock market crashes. I think it's Michael Gayed. You can find him on Twitter. Takes the 13-week average rate of change of lumber over gold, and when the rate of change goes under zero, he at least hedges or something like that. It's pretty good. It's pretty good. That's a weird correlation that has a lot of historical validity. It's not perfect. It'll lose you money sometimes and all of that, but it has played out for many, many decades. My problem with any kind of Bitcoin correlation is they've proved to be very temporal.
Right.
And so if it's that temporal and it's not solid, that has a high risk of losing you a heck of a lot of money. And so that's basically and then again, I would maintain that events often are held by the market in a way you would no longer expect, and you'd have to be able to predict when the market's going to take this or that. Again, interest rates. Okay, yeah, Bitcoin was coming down as interest rates are going up. Okay, yes, interest rates are still going up, and Bitcoin is going up. Right. So when was the shift between the two regimes, right? Like, when was the shift between the two correlation, and who can tell me why that shifted? And I haven't found a satisfactory answer. Now, I don't really care. I don't really care about the answer because I just trade price action. But I find great benefit in just saying, okay, whatever. Thanks for telling me that they're correlated like that. Obviously, it doesn't work that well. I never worried about it. It's just I mean, Avi will put it in probably more crass terms, but I prefer to kind of unpack it and go, let's take it to the strategic level and say, is this is it useful for trading? Is it useful for making? That's what I care about. I think when you look at Lynn Alden's work, you get a lot of like portfolio. She takes a macro view, and then we'll give like kind of I don't know if she does it for free, but I've seen them where she does. This is the macro view of portfolio. This is the allocation. Okay. And it's meant to weather through a lot of noise, as I understand, with that allocation. That makes sense to me based on that macro view. But when you get down to event correlation, again, like interest rates, very predictable. I don't know when it is. Like, pretty soon we're going to have another interest rate decision, right? Most likely it's going to be up. We can go look at the Fed futures. Fed futures determine what's going to go up. If you had shorted Bitcoin based on the last few Fed's decision points, you would have lost a lot of money, right? So that's my criticism of it. If that makes sense.
Yeah, no, that makes a lot of sense, and I definitely agree with what you say about it not being like a good trading strategy, right? Not something that you can work into a framework. But to that extent, I would have trouble to say, for example, Bitcoin's going to rally, even though like the US recession, there's going to be a huge recession and stocks are going to plummet, but somehow Bitcoin's going to still rally. That would surprise me a lot.
Yeah, I just divorce myself from anything that doesn't apply to strategy. Like, if I can't form a strategy out of it, it's just out of my, And no, don't get me wrong. Like, I do zoom out and say, like, I just look at my portfolio risk at a high level and say, how exposed am I, right? And of late, especially with the rally that we have, I see my crypto exposure is a little overheated. Right. When I buy a house, I'm going to feel a little overheated on real estate exposure. Right. So I'm going to be looking to balance that. I mean, gold are going to be good options. I think bonds are actually pretty good because the yield is pretty high and the potential for principal increases there. Maybe the bonds go a little lower, but at some point in time, we're going to hit a limit on that. So I look at that portfolio. Maybe that's not dissimilar to Lynn and how she looks at it on a macro perspective. I don't really know because I haven't gotten inside her head that way, but that's very different from looking at the next event tomorrow, today. I mean, what about the CPI and the PPI in the United States? I mean, I have a great trade for the CPI and PPI, and that's just fade the first move. I do it all the time. You get an inflation announcement. Okay, I don't care which way it goes, and then I see a little reversal, and once I can get a stop under that reversal, I fade it. And man, it doesn't always work, but it works really well most of the time. That's usually in the S&P 500. It's usually not in, or might be in gold, but usually it's not in crypto. But I do it every once in a while in crypto as well, because you just get that volatility, and often that volatility just breaks. It falters after like even like 5 minutes, sometimes 15 minutes, and a lot of money can be made very quickly. But that's about as far as I go. That's the trading strategy for CPI, and I'm not suggesting to try that at home. But that's as far as I go, because then I just wait for price action to settle down. Let's figure out what trend it's going to be on. Is it going to reverse the larger trend, or is it going to continue on the trend that we have, which right now is right now we've been correcting over the last couple of weeks, but the larger trend is up since 15,500. And so those are the only questions I ask. And I often dodge the event, because if one thing could be said, events are catalysts for volatility, right? I would say volatility and events correlation is nearly 1-to-1. At least certain events, right? Earnings, PPI, CPI, Fed funds. Okay, respect that. That gives me a lot of opportunities and options where you can short volatility. I do a lot of shorting volatility into the CPI, and then shorting implied volatility, not realized volatility, and then even fading the first move and all that stuff. Those are how I use earnings. But then after the event, let's see how price action settles in, and then we can start, seeing if we need to adjust our bets or for the swing trade, or if so. They are very important markers to me, but I don't have a preloaded strategy assuming this is what we're going to do. I'm always observe, wait, and see. Let's see what the market wants to do with this action, and then carry through. If that makes sense.
Yeah, no, absolutely. Yeah. I mean, there's always a way to retroactively kind of explain things away in that way. And then sometimes there's no reason for movements. And Bitcoin's one. I mean, just we got some pretty wild movements. When was it? Back on Wednesday or Thursday? We got that big rally.
And what was that? I have no idea still. Was there any
apparently the government was selling some Bitcoin, I heard on Twitter. I don't know.
But that came out like days before. So why did it happen that day?
I don't know. Beats me.
Yeah. I mean, if that's the U.S. government had sold like the week before or something like that. I can't remember exactly when it came out. I think was it Silk Road or something? I don't remember, but no, it was days before. Yeah. I mean, that was some weird action, but I still no one's explained it to me. I mean, and I don't need explanation. It just is what it is. Like, now let's let it settle out. I think we're still going lower short term, unless we break over the recent highs, of course, then I got to look up, but I'm actually right now the action I don't like, so I'm not making hard positions. But if we get a little bit lower into 21, 22, 21, I certainly will start to get a little aggressive on the long side, carefully, not any leverage or anything like that until the trend changes. But just being your cautious. If we turn up over, what is it, like Tuesday's high, whatever that high was, we turn over that, then maybe need to watch for, I'll watch for pullback. See, I mean, often when you break over a high level like that, and you think you're going to run and go, you fail again. But if you start to put another higher high in, and often you set up for going and you find some stability and they can keep running. So in those pullbacks, it's usually often when I trade.
Yeah,
most often.
Absolutely. Yeah, you got to be careful. I mean, when Bitcoin gets bullish, I mean, well, so far the pullbacks we've had have been pretty shallow, and we've had quick reversals so far. So got to watch out for that. All right. Well, we've covered a lot. I'm just going to ask you one more question, and then I'll let you go. Okay. You recently went to the Moneyshow in Las Vegas.
Yep.
I would just love to know how that was, maybe what the sentiment was there, and just anything interesting from that experience.
I was actually surprised how many people I had. Now to put in perspective, I've been in the Moneyshow. I've gone to the Moneyshow since 2018. So I'm a regular speaker, virtual or in person. Often in Vegas because I'm West Coast, it's easiest to go to. Also, I would say the crypto talks are more popular in Vegas. Maybe it's the gambling or whatever in Vegas. I don't know. But like in 2018, we were just after the top in 2017. The whole entire room was packed. People had to stand, and ever since then they've dwindled down. And but I was surprised how many. They gave me a very large room. I spoke at the floor, the open floor, Monday, and every seat was filled. It wasn't a lot of seats. It wasn't a huge. It was just a stage area on the open exhibit floor. So it was pretty filled. The Moneyshow tends to run older, so. That's the other thing is, you get some 20 somethings every once in a while, but most of them are retirees that show up there. So they're not going to be, buying Pepe, you'd hope not, right? Pepe or ApeCoin or whatever. You'd hope not.
They buy it at the right time,
Sure. But unless they have some expertise and want to get in and out, you hope not with their retirement funds anyway. And then that was a free talk, and then I don't get paid to talk at the Money Show, but there was a talk that they charged for in a room, and I followed behind a guy that was selling oil wells or shares of oil wells that he had been prospecting with his company, and I mean they were like $100,000 investments or something like that. I don't remember, and there was like 15 people, and then when I got my stuff prepared on stage, literally his crowd cleaned out, and then I had like 3 people in there, and it was a giant room that could have held like 150. I was like, oh great. Well, eventually before I started going, I probably got to about 30 people, which was about as most as I can expect. Again, older crowd, so I was surprised by that. That was a long way of saying I was surprised by how many people I had in that talk, that they were actually paying. A lot of good questions. I would say overall, most of the questions were from people that didn't seem like they had ever traded crypto. So we're curious. It wasn't like, I can tell the crowd's more experienced when they say, hey, what about, ApeCoin? Like whatever, they talk about some obscure altcoin because they're obviously bored with Bitcoin or something like that. Or you get very advanced talks like, okay, how do you secure your wallets and all of that? Like, what do you do, Ryan, for staying secure? I got a couple questions about the FTX thing, of course. So I would say that we've got a lot of crypto curious people, and that's good, given we've come off the bottom, 100% almost, or close to it, at least to the recent peak, 15,500 to it was around 31 or something like that, so it's pretty close. And then and I think the question is, the retail audience is always fickle, especially the ones that are already not into crypto and haven't traded regularly. Like if they're in a crypto curious stage, all you need is a 50% drop, and they're not coming back until it's at a high. And at the same time, when Bitcoin was at 60 in the 60,000s, my Facebook messages were popping up. Hey, it's too late to get into Bitcoin. Right. It's like, well, you're a little late now. And none of these people are asking me when we were down at 15.5 whether they can get in or not. So it's just that's the way the Money Show works. It's part of that crowd. It rolls with sentiment. In fact, even in the bear market, they cut back the crypto talks. I mean, I think people need the crypto talks in the bear market, but they cut it back. I think people need to prepare for the bull market when you're in a bear market, right?
That's kind of your buy signal, isn't it? When they cut out the crypto talks, that's what we want to be buying.
Yep, exactly. I mean, another buy signal, someone texts me and go, hey, Ryan, are you doing okay? Like we're down to 5,500. I'm getting texts like, hey, are you still in the business? Are you okay? No, I'm doing fine because I manage risk, but anyway, it's just funny. Yeah, it's funny how that goes.
All right. But, Ryan, it's been great having you on the show. Like I said, I've been following your work and Avi's for a while, so it's been great to have the chance to pick your brain for this time. Before we get off, just let everyone know where they can find you.
Yeah. I think if you're really curious about what I do, follow me on Twitter, RWILDAY. And then I do a public webinar. I try to hit the 3rd Saturday of every month as best I can, but I'll give a little indication about where it's going. It's a free webinar. You get a flavor. This is what I do every week for subscribers. Go through Bitcoin, Ether, a bunch of charts, and I go through a bunch of altcoins, which are selected. So crypto equities. Then I usually often talk strategy. So check that out. And then I always say, you can go to my profile on Twitter if you want to try the service. And on Elliott Wave Trader, we do it without any credit cards. So you can just sign up, email, password, and then if it's not for you, 2 weeks you have to ante up. But you get every single service, stocks, futures, all of this, the quant signals we have, all of that for 2 weeks. And then again, no one's calling you up and saying, hey, pony up. It's not a high pressure thing. It either works for you or it doesn't. But I've had people that have been with me since 2017 when we started. So check it out. Twitter, again, like I said, ElliottWaveTrader.net, or if you go through Seeking Alpha's marketplace services, and then that's Crypto Waves. So that's the other way to find us. So
great. Well, once again, Ryan, thanks for coming on. It was great talking to you.
All right.
All right. Bye-bye, everyone.